I'll talk about Narayan Murthy when he started Infosys, and Infosys started becoming slightly larger. Then there are stories about how thrifty he is. One fine morning, he called his co-founder saying that, yesterday night I was looking at water consumption, and our water consumption suddenly went up. This is not good. We are spending money for water. We should be very careful why our number of heads are not going up, but we are consuming more water. Then the other partner say, water, what do you care about it? It's hardly few rupees or few hundred rupees. Why it should bother you? So he was furious. He said, 100 rupees doesn't matter. That matters the most. If you take care of 100 rupees, only then this 100 will multiply many times and will create wealth for the nation. And that is how Infosys created wealth. So always remain vigilant about small expenses. And you will be able to remain vigilant if you record every transaction. Suppose you just spend 10 rupees on a rickshaw or a water rickshaw or something. You come to the office, you forget about it because you thought I have spent from my pocket, what to take care of that. But then what you should be doing is you should record that coming to the office. You should record in your accounts that 10 rupees has been spent on transportation or traveling. Because of many reasons. One, I said that you take care of the small change, then the millions will take care of itself. Another is you will, whatever you do, your actions will become a culture in the company. This is very important, and I don't know whether I have mentioned it at any point of time or not. Whatever you do, people working under you will look upon you, not explicitly, automatically. They will take cue from you. Suppose you spend 10 rupees and don't account for others may also think that, okay, means it's fine. Or maybe you do some small herapheri, and you think that it doesn't really matter. This is a small thing, and this is not so much unethical. And if your people come to know about it, they will definitely come to know you cannot really hide many things. They are going to copy the same thing without their knowledge, without your knowledge. And you will find that the whole culture in the company has become polluted. And you will blame others that my bunch of people are not good. They're cheating behind me. They're doing this, that. This is your fault, actually. You will not even realize that you initiated that. And that is why there is a saying, I don't know where I got it, but if the number one man in a company is honest, ethical, and efficient, the whole company culture will be influenced by that. The whole company will be different. And that applies to a country, that applies to a company, that applies to a small section also, in a hostel, in a class, everywhere. If the top person whom everybody looks upon to get some clue without their knowledge, they capture that. Without their knowledge, they capture. And then eventually that becomes a part of their journey in the life. So that is why we should be very careful when we deal with our juniors, our siblings, our employees. If the Prime Minister is okay with a bit of making money for himself or herself, or the person who is exercising the maximum power in a country, if that person is interested to make personal wealth or put personal wealth creation above the wealth creation for the nation, know for sure even a peon sitting maybe thousands kilometers away, but are in a way working in the same ecosystem, that philosophy will percolate down to the bottommost person. When Narendra Modi became the Prime Minister, after about a month, I went to a doctor. I was sitting there. Another lady was talking to the doctor that that person works somewhere at Kharagpur. She mentioned that, nowadays it has become very difficult for my husband to come just like that. Earlier he used to come whenever he used to decide that I have to go to a doctor. He used to come, but now he cannot take leave. He has to go right at the dot to report to the office, and then he cannot take a break in between. I am not appreciating a particular leader, but I'm just trying to give an example that the top man can percolate a message down to Kharagpur from Delhi, and that happens. that happens directly to people under him within no time. So you should be very careful, and accounting is very important because you can take care of all the small expenses and you can create wealth. Okay, let's move forward. 154. I'll finish whatever was unfinished the other yesterday, so that we don't repeat the same thing again and again. I went far from my actual cash flow. This is the actual cash flow. Net profit has gone down for whatever reason. Morning I was doing some jugglery. I was trying to make a blank page, and that is how data actually became data went kaput. I don't know why this has become 7,000. I made some change. Let me reverse that. I don't know. Oh my God. Just a second. Just a second. Yeah. Oh, that was another document. I created a blank document. So must have done something, and the data went kaput. This is okay. Operating profit. Whatever. Let's not bother so much about the data. The system should be okay. So we found that while preparing profit loss account, our balance sheet is created automatically. This is not only for finance class. Suppose you are preparing as yes.
The screen is not yet shared, sir. I couldn't see.
Yeah, meaning maybe because I have been doing jugglery, so maybe it has gone. Okay, yeah, thank you. Uh, the profit loss account has changed a bit. I don't know exactly what data I manipulated, but I cannot identify it now, so don't bother about it. Don't copy this. So yesterday I showed you that while preparing your profit loss account, the balance sheet gets populated automatically, almost all the components. Only thing that does not get populated is long-term loan is number one. Number two, your equity capital, that depends on how much money you bring. Then reserves and surplus gets automatically populated. Not automatically, you have to explicitly add them up. Then what does not get populated is I think nothing much is there, and that is the cash flow, cash that comes from the cash flow statement. Yeah, somebody mute your mic. It's creating noise.
Sir, only black screen is visible. Oh, okay, sir. Now it is.
Who is this guy? Pyare Chandu.
Sir, this is me, sir. Just now
You
the
want to
screen
say
was
something?
visible.
Fine,
That's what I want to tell
fine,
you.
fine. Okay, so there are only a very few items which do not get populated automatically in balance sheet. Whereas in cash flow statement, you have to explicitly put everything. But if you prepare a template, then cash flow statement also will get populated automatically. If you can really make a template with formulas so that you can pick up the data from specific cells, it can be done automatically. And if you suppose happen to start a startup and you do not have access to an accounting software, then you can make an Excel sheet and put all the data. And with this knowledge, you should be able to prepare profit loss account, balance sheet, cash flow statement. And if you do that with formulas at any point of time during the year, you can actually see how much profit you are making so far. But then you have to be exhaustive about all the data, meaning there are some data which do not come till the end of the financial year, like depreciation. You don't calculate based on how many days the asset has been used. You can do that. You can do that with the formula. Suppose depreciation rate is 10% and you are sitting on day 231, suppose, of the year. Then you can put a formula that out of 10%, how much is the depreciation till 231 days? That can be done without much problem. But okay, that is on a different context. Now, I'm not discussing the profit loss account. Let us mm, do more discussion on profit loss account. Now, cash in hand has to come from cash flow statement. So let's not worry about that. Closing stock is always given. Suppose you think in the context of your own business, say a stationery shop in your hostel, then whatever closing stock you have seen, you see at the end of the year on 31st of March 2021, you just put that data in your balance sheet. That is how it comes. In this particular context, I have already given the data because this is to be known automatically. This is to be known from facts. There is no calculation that my previous year closing stock was this and I have added that or subtracted that. There is nothing like that. This has to come from physical stock verification, physical inventory verification. They call it take inventory, meaning you estimate how much of things there are. So closing stock comes from that data, meaning you estimate how much of stock you are left with. You can physically do that by adding up all the cost of the pens, khatas and other things. Alternately, if you are maintaining your inventory well, this data will come automatically. How? Meaning whenever you estimate the previous year's closing stock, suppose previous year's closing stock is known, that was 14,200. This is already given because you have come to this year, meaning 2021. By the way, financial year is referred to as giving 2 years side by side. If I say 2021, that means the year started on 1st of April 20 and ended on 31st of March 21. That is how financial years are written. Say 2019-20, similarly 21-22, something like that. You may write 2021-2022, you may write 2021-22, whatever way you write, there will be a dash followed by the next year. So this is the mix of 2 years. Even our academic years are also that way. We are in the 2021 academic year. So autumn was in 20, spring is in 21. That is how the years are written. Now, in the year as on 31/3/2020, you have already taken the closing stock. We are in the year 2021, so it will end on 31st of March 21. And you want to see the stock. So how do you see that? You don't really add up all the pens. If you visit a stationery shop or a grocery shop or any shop for that matter, you will find that there are so much material, so many quantities that it's physically impossible for you to take stock of all the things, and it will never add up to real figure. There will always be mistakes. So that is why how you do that is like this. You start with the previous year's stock that is written in a khata, in a register, that is called general ledger stock. General ledger, all the major heads of accounts is represented by one general ledger. So there will be a stock register, the general ledger. Now whenever you begin the financial year as on 1st of April 2020, you start with the earlier year's closing stock because that stock is already there. So you don't have to estimate how much stock you have at the beginning of the year. You have closing stock, that is the beginning stock of the year. So you write that the first item, stock carried forward from the previous year. It comes here. Now, whenever you buy something, whenever you buy some stock, you just add that to this ledger. You add, suppose today you sent your employee to Gold Bazaar or Tech Market to bring some items to replenish your stock. So suppose he brings in items total worth of say 1,23,000. So along with 14,200, you just add that new stock arrives on so and so date, value this. So that is added. Now, whenever you add that, and at the end of the day, whatever you sold, there has to be an account, and that is to be deducted from the closing stock on a daily basis, so that you have a fair idea what is the value of the stock that you are sitting on. And you have to manage that stock, because inventory management is a huge thing. If you borrow money from bank, your objective should be to repay as much as possible, not to draw money from the bank. Suppose you have borrowed 1 crore rupees for a business. If you do not keep on crediting money, keep on depositing money in your account, at the end of the year, your total interest cost will be something like 15 lakh if the interest rate is 15%. Whereas if you keep on depositing money, suppose today you have 1 lakh rupees, just go to bank and deposit. Tomorrow you need 50,000 rupees or 1 lakh rupees, you can withdraw. That is how current account works, or overdraft and cash credit account works. Meaning you can always deposit whatever you want, you can always draw. There is no repayment for working capital account. That is a different discussion I should be doing later, but know for a fact that for working capital management, you have been given a limit by the bank. Suppose 1 crore rupees is the limit, so you can draw up to 1 crore rupees. Suppose on particular day you have 1 crore rupees of cash flow from somebody, you just go and deposit that 1 crore rupees and you withdraw that 1 crore rupees in the next day. You do not pay any interest for that day. One day you don't pay any interest. 15 lakh rupees, if 15 lakh rupees is the annual interest on a daily basis, you will find that this is substantial amount of money. Maybe one day's office expenses. So you save a lot of money if you can deposit. So that is why you should take stock and see what is the shape of the inventory. Suppose casually, because there is money in the bank, whenever there is somebody going to Gold Bazaar, you just tell him that, can you bring some stock for me? My vendor is so and so, he will be giving you, just packing you. You just bring the packet and it comes and you pay him, and you don't take care of the inventory. Meaning, how much is the inventory? Suppose your optimum inventory or minimum required inventory, suppose say 50,000 rupees. Suppose optimum means what? Meaning that should be the inventory. If you maintain that, then no customer will go back because there is no stock. For lack of stock, when no customer returns with empty handed, you have sufficient stock. Now beyond that, if you buy more, then you are unnecessarily blocking money, and that costs you not only interest but opportunity cost. You can put that money somewhere in a recurring deposit account or a fixed deposit account and earn some interest. So that is why you should never ever maintain more than required inventory or stock. So there are many books on inventory management that shows how to manage inventory efficiently, and you should always take care of that. But if you, as I started by saying that if you take care of the small changes, then only you can create wealth of millions. If you are not alert about them, if you're not careful about that, then millions will never come. So that is why you should focus on inventory management as well. And if you see that I don't really need stock, if somebody is going to Gold Bazaar, I don't have to really tell him to bring more. And that is why you need to look at your stock register. How much is a stock? Is there something which is depleted? I need to replenish. You should do only when you need maybe 10 pens in the stock, or say 100 khatas in the stock. If you see that there are 90, you should not buy. If you see that there are only 20 and there is a prospect that within 3 days no stock will come, so if somebody is going, or you may actually telephone and bring khatas, so that you have again 100 or something, but not beyond 100. Okay, that is why stock register is necessary, and that is how at the end of the year you will get closing stock data from there. Then trade receivable, same thing. Whenever you are sending some goods to somebody, or say in the context of a retail store in hostel, whenever somebody is buying and not paying, you are writing that in your khata. And if that person comes back after a few days and repay you back, pay the amount that he was owing to you, then you should immediately. Just a second, there's a courier. I'll come back in a minute. Just a second. Sorry, I have to give this PIN number. Just a second. Two two nine three. Oh, time consuming হয়ে যাচ্ছে। 293 হয়েছে? One to 99. Two to 93. One four 87. One 846. Extremely sorry, I shouldn't have done that, but the guy would be in, have to come again. Okay, so I was saying that receivables, whenever your friend comes back and pay you back, you again enter into that khata, so receivable goes down by that amount. Whenever somebody purchases and does not pay, receivable goes up because you add how much money you are supposed to get, and then at the end of the year you put that data here in the balance sheet. So these are available data, so automatically you get them. Then land comes from previous year. If you buy something or sell something, adjust for that and you get the data. Building, I have already told you, you start from previous year's data. Then if you buy anything, you add them. If you sell anything, subtract them, and then you depreciate the total net amount to get net value of the fixed asset. Meaning total asset minus depreciation is the net value that comes here. Similarly, machinery, you start with previous year's data, you buy something, you add them, you sell something, subtract and get the total value. It was total was 21,320. So sold during year, that is subtracted, and then total became 18,920. You minus depreciation, and then whatever remains that comes here automatically. So this gets populated. Similarly, if you have any items that is to be amortized, here it is preliminary pre-operative expenses, you have amortized 200 rupees. So just subtract whatever has been amortized because that has already been taken into account. So 200 rupees goes out of 500, you are left with 300. This part is already done. Trade payable comes from your khata, meaning anytime you buy some material and you don't pay, you just add that in your khata on trade payable. So this is supposed to be paid. So you keep that, you keep that in account so that you gradually at any point of time you have a fair idea how much money you have to pay. And at times you pay, you send him a check or money, you deduct that from the trade payable account. At the end of the year, whatever is the net balance, you just put it in the balance sheet. Short-term bank loan account. Remember this, short-term and long-term are very different. Short-term bank loan account, the outstanding balance is to be taken from the bank. Whatever I said about depositing money, withdrawing money, this is short-term bank loan. Like overdraft and cash credit, we'll discuss that when we discuss about funding new venture. So short-term loan account, you have to take from the bank. So in the context of a example giving here, I have already provided that data because you cannot go to the bank, imaginary bank, and get that data. So this comes from here. Whereas long-term bank loan account, you have to do some calculation. Everything else I said, you just get it from your ledger. Whereas long-term loan has to be is connected to some previous year's data and some repayment, and if you raise any loan. So long-term loan, earlier year it was 5,600. That means bank is supposed to get 5,600 from you. Bank is supposed to get 5,600 from you. But during the year, you have actually repaid some money. that you should get from your khata, from your ledger, how much money you have repaid to the bank. So here, repayment of bank loan is 1600. So if you pay 1600, out of 5600, you are left with only 4000. So that comes here automatically. But suppose if I would have told you that you repaid 1600 maybe at the beginning of the year, but at some point of time to buy another asset, you have raised fresh loan of 2000. So that is to be added now. So whatever you repay, you deduct. Whatever you raise afresh, you have to add. So 4000 will become 4000 plus 2000, 6000, depending on whatever you do. So term loan is estimated that way. Now, equity capital, we discussed yesterday that this capital normally is never reduced unless you buy back and extinct some of the shares. Corporates sometimes do that, but forget about that exceptional thing. Ordinarily, it does not go down. It may always go up, or it remains constant. So earlier year it was 7,500. This year, the owners or founders, they thought we need more money, or maybe they have inducted a new co-founder. He or she brought in another 1,000 rupees. So this became 7,500 plus whatever money has come, that became 8,500. Reserves and surplus is a carry forward item, always remains in the balance sheet. Whenever you make profit, is added here. If you incur loss, is subtracted from here. Whenever you make profit, like here it is 7,000, I don't know, it was 10,000 something yesterday. This was 10,000 something yesterday. So some data has changed, whatever that is. So reserves and surplus, earlier year it was this, and this year the retained profit is this, that is added, and you get this data. Suppose here it was a loss of 1,000, then that 1,000 will be deducted from here and you will write it here. As long as this does not become negative. If it becomes negative, then it goes to the asset side as positive. Normally balance sheet doesn't have any negative data, always positive. So whenever it becomes negative, that goes to the asset side. Why? Can anybody say why? You may not be able to. I don't expect you to say that, but you know, there are exceptionally talented guys among you. Maybe it will hit somebody's mind, because I told you earlier that assets are where we apply our money. Assets are those where we apply the money, and liabilities are sources from where we get money. So when reserves and surplus is positive, that's a source of money because it came from profit. But when it becomes zero, it no longer remains a source. The moment it becomes negative, that means there was loss. So you have to fund the loss. Loss has to be funded from somewhere. Remember this very clearly. If there is loss, if there is any loss, then you have to fund that. Money has to come from somewhere for you to incur loss. Suppose your business is something, suppose total money in the business is say 1 lakh rupees. Now say 1 crore rupees. Now in particular year, your loss is 2 crore. That can never happen, because loss will be 2 crore only when you will supply something worth 2 crore and you have, or worth much more, and you get in return less than 2 crore. 2 crore less than whatever is the cost. 2 crore rupees less than whatever is the cost of production. So you definitely need more money to produce goods worth more than 2 crore. So for incurring any loss, you have to have the money. Money should come from somewhere. Suppose there is no money to incur loss. Immediately you have to run from pillar to post to get money so that you can incur more loss. Whatever. That may not be the right connotation, but for you to incur loss, there should be money. So if it is negative, it comes here because that is an application of money. You have put in money to incur loss. Okay, let's move to cash flow statement. For some reason, my status bar is not moving. That is why I'm not able to. Okay, this will do. Okay, let me see if it works here. Doesn't work. Sometimes it works. Actually, I have too many tabs open. Now, cash flow statement, there is a direct method and an indirect method. Direct method is very difficult, very long, not difficult, very long. In the direct method, you will be entering almost all the data that you enter here in operating expenses. All the expenses will be shown, the sales will be shown, almost all these data, at least maybe something like 60% of this data will come there. Whereas we have made it short in the indirect method, only this portion comes, this 8,836 net profit comes there, meaning we have already done all this, that is already demonstrated there. So this comes here of net profit. And why all this comes under operation and why they are positive and negative, that is to be understood very thoroughly. See, depreciation and amortization is an expense for which you have not made any payment. You have made payment when you bought the machine. Suppose you buy a machine this year. Suppose you buy a machine this year, then you will show it here. Whatever money you incur to buy a machine, that is shown in the same year. In the same year, you show that as a negative cash flow. So 14,520 is a total negative cash flow because we bought machines worth 14,520. That is why this money went away from the company. It's a negative cash flow. And that comes under investment because we invest money to buy a machine. Why this is an investment? Because this machine remains with us for a long time. So this is a capital investment. But after this cash flow, in the next year or year after next, every year will be depreciating that asset. Remember, this money was not shown under operating expenses. Even though we incurred this cost for buying machinery, that was not deducted as operating expenses here because that's a capital in nature, number one. Number two, we are going to derive the benefit for many years to come. That is why we don't show investment in capital asset as expense. That's a cost for procuring the asset. But we allocate only a small portion of that cost to the extent we use up the asset. And if we think that the asset will have 10 years of life, then we use up only 1/10 of that. And that is why we apply depreciation at the rate of 10%. This is not sacrosanct. Sacrosanct means universal truth because depreciation changes from 10% to 20 to 33 to many things. You may not even depreciate an asset thinking that I don't care. This asset will remain for 100 years. Who cares? 100 years, 10 years, 15 years. I don't want to depreciate. That is your prerogative. But then there is always a justification for doing everything. You don't do whimsically that I just want to violate the accounting system. That is why I don't do. That doesn't happen. So this comes in the cash flow, but then you also incur the cost as depreciation, but you don't pay money to anybody. So in the profit loss account, look at the profit loss account. Your operating expenses include depreciation. That means if you would not have considered depreciation as an expense, listen carefully. If you would not have considered depreciation as an expense, your profit would have gone up by that amount, pre-tax profit at least. Your pre-tax profit would have, suppose you just eliminate this data, there is no depreciation, we don't consider depreciation, just delete that. Your profit goes up by that amount. Whatever is the depreciation, your profit goes, because depreciation is no longer an expense. But we don't want to do that. Why? Because we know that machineries are getting weird and teared and their life is limited. We have to recover that cost that we have incurred in the first year while procuring. So we want to depreciate them and allow a small portion. We apportion them over the years. So this year we have apportioned 10% of the cost. That is why what is depreciation. But then we have not made any payment. We made the payment in the first year while procuring, and that is why it came negative. This year and next year and next to next, we are not going to pay anybody. But then we have this amount. Depreciation 1925, amortization 200, two together is this. If you want, you can show separately, amortization separately. In fact, most of the people show amortization separately. Otherwise, even you may get confused later as to how this is, the data has come. Depreciation is only 1957, whereas this data is 2157. So amortization another 200. Change in inventory. Try to understand this clearly and once for all. Don't try to means, if listen very carefully, focus and focus. See, earlier year your closing stock was 14,200. Now, as at the beginning I spent so much time explaining how closing stock is estimated, try to revisit that process. You will realize that if the stock has gone up by any amount, this needed money. You had to spend money to increase the stock from here to here. So how much money? 1200 rupees, 1200 rupees. You had to shell out 1200 more money to increase the stock. And that is why the increase in inventory is a cash flow negative. It's a negative cash flow. Here it is positive, but we normally take it there as negative. We put the negative sign, inbuilt negative sign here, and then that comes automatically. I have put a plus sign, whatever that is, forget about that, but we can show here as is equal to negative. The is equal to has to be there, the negative this, and again negative amortization. Amortization is here, and enter. So the this is positive. I'm sorry. Earlier it was right. This is not negative that. This is negative this minus this, this minus this. Forget about that. Let us not get confused about that. We can, what we can do is this is equal to negative this minus this. So automatically it will come negative and then we take that data. But otherwise what I have shown is future data minus past data. 15,000 minus this plus 200. That is how it is here. So I took directly from D. D means depreciation and then amortization. I added them up. So that is your convention. Don't worry about that. Let's not waste time. Change in inventory. Sorry, why I have come to depreciation? I was talking about inventory. Change in inventory. Yeah, I wrongly added amortization and all that. Very sorry, very sorry. Please recoil the whole discussion. I was talking about inventory. So inventory has gone up. That means we have spent some money to buy the additional inventory. So that is why we have shelled out some money. So this is negative. Change in accounts receivable. In the same way, our account receivable was 9,100. Now it has gone down. That means we have recovered some money. So you have to know what is account receivable. Account receivable is nothing but you have supplied goods to students and they have not paid up. That value was 9,100. But this year you find it is 8,100. Then you think that, wow, this is good. I have recovered more money. So that is how receivable is going down. So less the receivable, better it is. If you see any company making huge profit, but the receivables are going up, that means profit is in the book. They are actually not able to recover the money that they are selling. So some company, they are selling and selling, customers are buying and buying, they're not paying. So that is why receivables are going up, and in fine morning they will realize that these customers are not going to pay. So they will write it off and that they will enter deep into loss, cash loss, and then eventually they may not sustain. So receivable has gone down. That means there was positive cash flow, meaning more people paid. So cash has come. That is how receivable has gone down. That is why this is positive. Change in account payable. Account payable is just the reverse of that. What is accounts payable? Accounts payable are the vendors who have supplied you goods and they are yet to receive the payment. If this goes up, they have supplied more goods and they are supposed to receive more money. That means you are doing business with their money. So that is why this is called cash equivalent, not cash, but cash equivalent. So you got some extra goods worth 957 without really making payment. So that is as good as getting money. That is why this is positive. So you add them up with the signature, whatever that is, minus plus, you get this is the net cash flow from operating activities. And this is positive. This is positive. Then cash flow from investment activities. See, first of is change in building, not change building, change in value of building or whatever. Meaning if there is a new construction in the building, then it should, that money has gone away because you had to pay money to build that. That is why that is negative. Suppose you sold some building asset, then that will be positive cash flow. I'll show you very soon. Machinery. Total machinery you bought, that is 14,520. That money has gone out from you from your company. That is why it is negative cash flow. But you sold a machine for 2,400. You sold a machine for 2,400. That means you got that money from the guy who bought it. So that is a positive cash flow. This is exactly the value that you receive. Whatever money you receive, that comes here. Now suppose you receive more money than your book value. Suppose this asset has a book value, that I'll come to that later. First of all, let me complete this because there is a twist in that. Now you add them up with all the signature, you get 12,420. That is negative cash flow. This is positive cash flow. This is negative cash flow. This is a net amount of cash that has gone out of the business for investment purposes, meaning buying, selling machines. Third is financing activities. Financing activities are nothing but where from you raise your finance. Remember this way, financing activities means raising finance. So how you raise finance? One is you bring in equity capital. In that way you can bring in money. Then you raise term loan, long-term loan. You raise short-term loan. Then you pay dividend. If you pay dividend, that money goes out. And then eventually you get the total cash flow from financing activity that you add with the previous years to get the current year's balance. Now, change in term loan is very critical and you should understand that. We have repaid term loan to the extent of 1,600 rupees. So this money has gone back to the bank from our account. So that is a negative cash flow. Whatever long-term loan you are repaying, that is a negative cash flow. If you are raising any new loan, there is a positive cash flow because bank is giving you money. You raise a loan. That's what is happening with the short-term loan. See, short-term loan, previous year it was 9430, but this year it is 9900. That means you have drawn some extra money from the bank. How much is that? 470. So 470 rupees came from the bank. That is a positive cash flow. So this becomes 470. Now we have already mentioned that one of the co-founders or maybe a new founder has brought in 1,000 rupees. So this has come to the company. That is how it's a positive cash flow. Dividend is paid outside. Dividend is paid away. That is why dividend goes out. So if you consider this as net profit, then you have to consider dividend here. So that is why we have taken this data, net profit, not retained profit. If you take this data, you don't have to show dividend, but you are showing net profit. Then from net profit, you are paying dividend. That is why it came here. That's what I wanted to mention. Then I realized that I didn't put dividend here. I just put 3 items. So at times I do for different purposes. That is why. But here it is right. So you start with net profit and then you show dividend here. And then you add them up, you get minus 131130. So total cash flow, meaning this one, then plus this one comes with a negative sign, plus this one comes with a negative sign, and that becomes negative. Very dangerous situation. This company during this year incurred a negative cash flow of 1800. This is very dangerous. Any year you have a negative cash flow, you should be very much concerned, and then you should take note of it, sit up, and then immediately run from pillar to post to get more money, like angel investor, then bank, then friends, family, and means family and friends and whatnot, to raise more money so that you have at least 1800 rupees brought in, so that there's no net cash outflow. And maybe next year you will have the same picture, like there will be more negative cash flow. So you have to raise more than 1800, because unless business is changing for the better, you may actually end up requiring more money. So you should be careful. And then you should look into the balance sheet and see what was the cash with me at the beginning of the year. This is the cash at the end of the previous year. So automatically this becomes the cash in the current year as well at the beginning. So you started this year with this amount of cash. So add them with this. You have consumed this cash. You started with this. Net amount is 140. This should come here. Now you can put that. So 140 came from there, and then closing stock and all that. So total becomes 42,703, 42,703 automatically it became. Okay. So that is how the balance sheet, cash flow statement, and profit loss accounts are prepared, and everything is balanced. There is no way this will not be balanced if you make everything correct. I've shown you by changing various data and then how it becomes kind of okay. Just a second. Okay, so is there a question? If there is a question, let me know. Okay, so if there is no question, then let us do the same thing with a blank document, so that you can appreciate. Now, first thing, whenever the sum is there, first thing you need to do is estimate gross profit. How do you estimate gross profit? You bring the sales. Sales is equal to, is already given somewhere. Sales of goods is this. Then there might be other income. So truck hiring was another income. So is equal to truck hiring charge you have received from somebody. So total income becomes this plus this. That is the total income. Now for estimating operating profit, you need to understand operating expenses. How do you understand? You have to estimate the depreciation first. So this is depreciation. We come here, building asset value as per last year account is equal to, you have to get it from the balance sheet. I'm sorry. Yeah, it's here last year. So plant and building is 1000. So you bring this from here. Then purchase during the year is equal to, did we buy anything? We have to go back and see. Construction of factory shed is here. There is no other asset. We already know that subtotal is equal to this plus this. We get this. And then sold during the year is nothing. So we don't have to do anything. Total is equal to this minus sold. Sorry. Minus whatever we sold, that was nothing, so it becomes this. Depreciation is equal to this multiplied by 0.05, because 5% is a depreciation rate, 65. So it's gone. So what is the net value is equal to this minus this. This is the value. So this should go to the balance sheet and populate my next year's balance sheet building. This is equal to the net value. So we get one data in the balance sheet in the process of doing this only. Machinery value as per balance sheet, last year balance sheet. Where is the machinery? Machinery is here, plant and machinery. So you just pick up data from that. Oh, sorry, I didn't put the equal to sign. Equal to, this is the machinery in the last year balance sheet. So it comes here automatically. Machinery value as per last year account. Machines we bought, where is that? We bought a machine for 12,000 rupees. We have shown it here. This is the machine that we bought. It comes here. Then we bought a new truck also. So is equal to, where is the new truck that we bought? Purchase of truck here, this. So we just pick up that data here. Truck comes here. Telephone. Telephone is equal to, this is telephone bill, not the telephone. Telephone is different. So we bought a telephone. You have to see that. Purchase of telephone, 20 rupees only. So these are the total asset. Now I'm doing a shortcut because I already know that these data are there. In real life, you have to really sift through them and then identify what are the fixed asset, color it differently, or mark a tick with a or a cross or some other sign so that you have the whole this thing. Then is equal to this. Total is this. Purchase during the year. Subtotal. Oh, I'm sorry. This should not start from 28. It should start from 29. This is the total that you bought. I actually added all of them. Subtotal is equal to this plus whatever was there in the balance sheet. That becomes subtotal. Sold during the year is equal to 2,400. We already know. So we pick up from there. Sold fixed asset worth 2,400 comes from there. So this is to be subtracted. Total is this minus whatever we sold. That is the total. Depreciation is equal to this into 10%. That means 0.1. So this is the depreciation. What is the net value of asset? Net fixed asset is equal to this minus depreciation. This value should go to the balance sheet. So balance sheet, when I want to write the next year's data, will show equal to this net value. So one data, another data in the balance sheet is automatically populated. Okay. Now we already have depreciation of the building. We have depreciation of the plant machinery. So total depreciation is equal to this depreciation plus that depreciation. This is the total depreciation. Now we can estimate operating expenses is equal to, we can start with depreciation. There is no harm. Plus we have to now come here. Whatever is the operational expenses, just keep on adding. Truck hiring is not. That is an income. Payment of rent is 1 plus advertisement expenses is another one. I have already colored. Salary is 1. Transportation expenses is 1. Maintenance is another one. Legal expenses is another one. Then truck hiring is an income. Amortization is another one. So we have added that now. Telephone bill payment is another one. Electricity bill payment another one. Sale of goods has already gone to gross profit calculation, so don't do it now. Insurance is another one. Audit fee is 1. Traveling expenses is 1. Stationery is another one. That's it. So I don't need this plus sign anymore. Just enter and we have the operating expenses. What is operating profit? Gross profit minus operating expenses, which is here. Enter. We have gross operating profit here. What is the interest? Interest is already given and it has to be given. You cannot invent or discover the data. Otherwise, interest to bank is this. So this is our interest. So profit after tax is operating profit minus interest is this. So this is our profit before tax. What is income tax? At 20%. Oh, I have added 20% is equal to this multiplied by 0.2, and this is our income tax. Net profit is equal to operating profit minus income tax is equal to this. Okay, this is coming too big. I think I have made a mistake. I think I have taken the sales as gross profit. That is not gross profit. Gross profit, I have not estimated gross profit. We have to estimate the gross. This is just total income. Gross profit is equal to, first of all, opening stock. So is equal to opening stock. You can take it from here, take it from closing stock in the balance sheet. Where is that? Closing stock, inventory, cash, closing stock. This is the opening stock. This is the opening stock. Purchase is equal to, see, stock purchase, goods purchase, purchase of telephone. It should be somewhere here. How much is that? 85,000. This is purchase of goods. So is equal to this. So goods available is equal to purchase plus what you inherited from previous year becomes this. Closing stock. This is to be given. This is to come from your ledger. That is why I have given it here. Closing stock is this. So you subtract that. Cost of goods sold is equal to total available stock minus stock that you could not consume. That is a closing stock. Then it becomes cost of goods sold. Gross profit is nothing but total sales or total revenue minus cost of goods sold. So it becomes 66,500. And operating profit is equal to gross profit minus operating expenses. So now, oh, this is false. This is equal to, sorry. This is okay. Operating profit is equal to, where is the gross profit? This is the gross profit minus operating expenses. So this becomes operating profit. This looks okay. I don't know. Again, the data has changed for whatever reason. Don't forget about that. Operating profit is this. Let me see the time. Yeah, let us go fast. Then you pay interest, then profit before tax, then income tax, then net profit. You pay dividend here of 1,000 and you get retained profit. This minus this. I'm doing it in a hurry, so maybe I have omitted some of this from somewhere. That is why the data came like this, or maybe they are right. Now this is your retained earning. So profit loss is done. Now for balance sheet, cash should come from cash flow statement. Closing stock is already given. You can put it with the formula also. It is given here. 15,000 something. This is the closing stock. You have to take it from there. It has to come from your register. Similarly, receivable also has to come from your ledger. Whatever has to come from your ledger, I have already given it here. So receivable. Traveling. Oh my God. Traveling expense. It is supposed to receivable. So it is 8,100. It comes here. By the by, I have already taken attendance. If any of you or all of you have classes right now, you feel free to quit because I'll be covering this again during the tutorial. You can attend the tutorial and you don't have to miss any other class. I'll continue because continue at my cost. This will be repeated. Okay, so kindly feel free. Otherwise, you stay put. And let me complete. It will be a repetition in the tutorial, so you will get it repeated. I expect that many people will may not have class now, and they will stay. Now, prepaid expenses. There is nothing. There is no prepaid expenses. I have not explained. So you can actually keep it estimated. You can increase the formula up to here because at some point of time cash will come. Then land, we have not purchased any land, so it comes automatically here. And then building has already come. This has already come. Preliminary pre-operative is equal to this minus whatever amortization you have done. You have done 200, so 300 comes here. Total non-current expenses is equal to, you do a sum of to here and you get it 19063. I don't know if they're right. Total asset is equal to this plus this. Done. So that is the total asset. Now trade payable. Similarly, trade payable like account receivable, they should come from khata. So whatever should come from khata, I have put it here. Trade payable is here. So these are given. You don't have to use your brain to prepare balance sheet. Short-term bank loan, again, this has to come from the bank. You cannot go to the bank. That is why I have already given it here. Short-term bank loan should be repayment, interest, sale, fresh long-term amount. Should have been in a different color. I don't know. Yeah, outstanding short-term bank loan is here. So it is already populated. Total is equal to this plus that. Done. Now long-term bank loan, as I said, follow very carefully. You start from here. Previous balance plus if you have raised any loan, or maybe minus first. Minus if you have made any repayment whatsoever. So repayment of bank loan is this. Okay. Repayment of bank loan is this. Okay, now this is minus plus if you have raised any money during the year. See, fresh long-term loan raised 9,000, so that is to be added. Now it has become 13,000. Perhaps I forgot to mention that in the previous balance sheet. Now subtotal of liabilities is equal to this plus short-term bank loan is equal to this, so 31,617. Now fully paid up equity capital, this is equal to previous years plus if you have raised any equity, you have raised fresh equity is this. So you add them up, it becomes 8,500. Then reserves and surplus is equal to, as I said, this value plus net profit this year. Whatever is the net profit, this. So you add them up. So this becomes this. Total owner's equity is this plus this. You have to do it separately because that is a very important data. Is equal to this plus this. Get this? Meaning whatever is the owner's equity plus whatever is the total liabilities. Now comes the test. 13,000 is 31 plus, why this is so low, is equal to this plus 31. Yeah, 49. But there it is 42. Why? Because the cash flow is to be done. So we'll do the cash flow very quickly. Net profit is equal to, again using the formula, it comes from here, no hurry. Then depreciation and amortization is equal to whatever is the depreciation. You can take it from here, you can take it from some other place. Total depreciation is this plus amortization is this. Get this data. Then change in inventory is equal to, if inventory goes up, then it is negative. That is why you should start from here minus this. So it comes with signature. That's what I wanted to mention. Increase or decrease in inventory should start from here to here, because if it increases, it becomes minus. Change in account receivable, same thing. This minus this. If it goes up, it will be negative. If it goes down, it will be positive. Change in accounts payable is equal to, this should be the other way around. Meaning this should be from this side to that side. Trade payable. This minus this. If it goes up, it's positive. If it goes down, it's negative. So now this is equal to, just do the sum and you have it. 8,212. Data may not match because we have done some mistakes here and there. But then balance sheet will match. Don't worry. From investment activity. Change building. Building we bought for 300. So let us do with the formula at the cost of time. Construction of factory shed. Gone. Then machinery is equal to whatever we bought during the year should come here. That is the money we spent. Don't consider depreciation. Do not consider depreciation because that is an accounting entry. This is the machine we bought. This is the money we spent for buying machine that comes here. Sold machine. So is equal to, now we make a subtotal because sold will be okay. But here it should be negative because money is going out. I forgot to do that. And here also, this also money is going out. So is equal to negative this, and this becomes negative. Sold machine is equal to, it is positive because money is coming in. that is slightly critical. So this becomes positive. And subtotal is equal to, not equal to, is this, and go up to here. So it is minus 27. I don't know how. Okay. So don't do this subtotaling. That is why it is becoming like that. No subtotaling. So it becomes minus 12,000. From financing activity, change in long-term loan. If you remember, I said long-term loan was how much? It was this. It was this. Then whatever you repaid, that money has, you can actually do that. You can break it up. Sorry, no, don't look at this. You can break it up. Let us do that way. Will be better. Okay, so long-term loan, or maybe you can write fresh long-term loan raised. So that comes as positive. Then comes repayment. Long-term loan, that comes as negative. Then change in short-term loan. I don't know, in the process I may make a mistake. Changing short-term loan. Short loan. So let us do first. Fresh long-term loan. Did we raise fresh long-term loan? Yes. This should be is equal to 9,000 rupees we raised as fresh long-term loan. That comes as positive because money is coming in, whereas repayment is equal to negative. Sorry, is equal to negative. Which one? Repayment of bank loan is 1600. So this becomes negative 1600. Change in short-term loan is a direct plus minus. This year it is short-term loan. Where is that? Long-term, short-term loan. This minus that. Why? Because if it has gone up, then it's a positive cash flow. Sorry. This minus this. So loan has gone up, that is why it is positive. Change in equity is equal to whatever equity you have inducted. This is here. No, not dividend. Founders bring in new equity. This is the one. So it comes here. Okay, I think that's done. Dividend is equal to, dividend goes out, that is why it is negative. So you show it from this one, so it is negative. Now subtotal, you should always have a subtotal or total funds flow or cash flow from financing activity is equal to, just do the sum, you get it. Now you say total cash flow, net cash flow. Net cash flow during the year. So this should be is equal to the total, meaning cash flow from this plus cash flow from this plus cash flow from this. So it becomes 3,662. That is a net cash flow. Balance brought forward is from previous year. Whatever is the cash, you just bring it from there, and that becomes the previous year's balance. So total is equal to, we made a cash net flow of this, plus we made another cash flow of this. Total becomes 5,602. That automatically comes here. I don't know how this is not showing, is this, and it comes there. Yeah. So total becomes 48,165. It is 49,165. So I made a mistake about 1,000 somewhere here. This is 48,000. So I think I have added 1,000 somewhere by mistake. This is
in retained earnings, should we not deduct 1,000 of dividend?
Yes, I made this mistake. Is equal to this plus retained earning, not net profit. So now it is 48,165, 48. Thank you. Who said this? Let me know the name.
So Tushar here.
Come again.
Tushar Singla.
Tushar Singla. Okay, okay. Thank you, thank you. You noticed it very nicely. I'm so happy that at least means not at least many people are watching very carefully, but thank you. But notice another thing, that if you make a mistake, then looking at the data, you can go back. Like I said, it was difference of 1,000. So we should look at 1,000 figure somewhere at the back. So wherever there are 1,000, you can get it. So intuitively, perhaps you found that 1,000 is a dividend. So maybe there is the mistake, etc., etc. So I have done everything in maybe say something like 30 minutes or so, not even 30 minutes, 20 minutes. So I just wanted to demonstrate how to do it. And I also wanted to demonstrate that it is so easy to do, provided you have everything correct. You do not actually, you do not think that this is so difficult a thing. You should not think. It's so simple. Everything is so step by step and automatic. Okay, only thing is that you have to know the convention, and that's it. So thank you so much. We'll meet during the tutorial. One guy complained about the timing. I really, it's very difficult to change the time because there are 244 students. You should appreciate that everybody will have some inconvenience at some point of time or other. So please bear with me. There will be recording of that, and I have discussed quite extensively during class hours. I took 3 hours for this class, which I could have completed in one single lecture. You have seen it takes 30 minutes to complete, not even 30, I think 20 minutes or so I took. So please bear with me and see the video where if you miss the tutorial. Okay, thank you. If you have question, you can, yeah, go ahead.
Sir, I have a question in the cash flow statement.
Okay, go ahead.
Could you please explain why did we include the depreciation and amortization as positive in the operating cash flow, as we are not receiving any kind of cash?
Yes, it's a good question. We are actually receiving cash. That's what I wanted to communicate when I said that look at this operating expenses. Operating expenses include depreciation and amortization. Both are included here. Okay. Suppose we do not include depreciation as an expense, we eliminate that. Then look at the profit. Profit goes up. Profit goes up. But we have not made this profit because depreciation cost is already there. So we are considering depreciation as an expense, but we are not making payment to anybody. That money remains with me. It is just an accounting entry or accounting adjustment. It is just an entry. We are not paying this money to anybody. We paid this money at the time of purchase, and that came here. That came right here in the cash flow. But later, this comes only once when you buy. But in the subsequent years, you have to recover this money, and you recover money, all the money from sales in the form of cost. Anything that you add to the cost is recovery of that expense out of sales. See, we estimated gross profit out of sales because cost of gross profit is nothing but sales minus cost of goods sold. So we have recovered all the stock. Here in operating profit, we have recovered all the operating expenses. So then we are left with profit before tax. If we do not allow depreciation as an expense, we won't be able to recover that. But then we did not pay this money to anybody during the year. That is why this money remains with us. This money remains with us. But if we do not show that explicitly, see, this money does not contain depreciation. This is net of depreciation. So when we show cash flow statement, this is net of depreciation. This money is net of depreciation. That is why depreciation means we have deducted depreciation. That is why this money is less by that amount. That is why we have to add it so that we take into account the adjustment that we did here. You think more. I think if you have residual doubt, then we'll clarify during tutorial if you happen to attend. Otherwise, I'll write you separately.
Sure, sir. Thank you,
Okay.
sir.
Yeah, welcome. So we'll call it a day here.
Thank you, sir.
Thank you. I have to stop recording.